Natalie. Welcome everyone to today's Baird Wealth Strategies call, Finance for the Greater Good. Today we have two of my colleagues from Baird joining us today. Our first speaker is John Taft, and John is the Vice Chairman of Baird and a member of the firm's Executive Committee. Prior to joining us here at Baird, he served for more than a decade as CEO of RBC with nearly 2,000 financial advisors and over $280 billion in assets. Relevant to today's topic, John is an author of two books. The first title is Stewardship, Lessons Learned from the Lost Culture of Wall Street, and A Force for Good, How Enlightened Finance Can Restore Faith in Capitalism. John is a graduate of Yale University with both a BA and a master's degree in public and private management. John is very committed to community activity and serves on a number of boards and is a volunteer for a number of organizations, including the Itasca Project. He's also on the board of the Minneapolis Foundation and the Andy Warhol Foundation for the Visual Arts. He credits his commitment to community involvement, inclusion, and diversity because of his family legacy, including his great-grandfather, 27th U.S. President William Howard Taft. So many thanks, John, for joining us today. Our second speaker will be Katie Schoen, and Katie will be sharing her insights after John speaks. Katie's our manager of our private wealth management, equity, and fixed income research, and she's a resource to both our financial advisors and their clients as they build portfolios. Katie's had a very successful career here at Baird, joining us in 2008 as an equity analyst, being promoted to senior analyst and eventually manager of the overall team. She's a voting member of our recommended equity portfolio and contributes to the construction of our PWM opportunities list and is also responsible for overseeing our exchange-traded products list and research. She is a graduate of Marquette University and has furthered her education and in the career, receiving her Chartered Financial Analyst and Chartered Alternative Investment Analyst designation, both of which are extremely rigorous designations to acquire. When she doesn't spend time at Baird, she loves spending time with her husband and children, and she's involved with many organizations, including the Baird's Women Associate Resource Group, the board of the CFA Society of Milwaukee, as well as the board of the Girls on the Run of Greater Milwaukee. So many thanks to both John and Katie for their comments today. And as I mentioned, John will kick us off, and then Katie will share her views after John. So John, the floor is yours.
Thank you, Loretta. Hello, everyone. As Loretta alluded to, I've been spending much of the past decade traveling around the country, speaking and writing about what I call responsible finance, about how finance can and should be a force for good in society. And one of the ways we can do that is by helping investors, whether individual investors or institutional investors, put your money into businesses that reflect your values, into businesses that demonstrate responsible behavior, and into businesses that contribute to improving, not degrading, our overall standards of living. The agenda for today's call is mostly educational, to give you an overview of the whole field of socially responsible investing, to talk about what kind of investment solutions are available if you're interested in getting involved as an investor in this space, talk about what's always the elephant in the room with socially responsible investing, and that is how do socially responsible investments compare to traditional investments when it comes to performance, and then at the end step back, broadly speaking about wealth management, not simply investment solutions, as an area where you can put your values to work. Now, there's been a lot of dialogue recently about a couple of topics. One, should investment advisors have any objective other than maximizing investment returns for their clients? And secondly, about whether executives who manage businesses should have any objective other than maximizing profits for their shareholders. Well, both those notions took hold in the 1960s, and quite frankly, we have been steadily evolving and moving beyond those constructs since then, and certainly in the last decade. Now, just yesterday, some of you might have seen, it was widely reported that a group called the Business Roundtable, which is chaired by Jamie Dimon, CEO of J.P. Morgan, and includes a star-studded board, Ginny Rometty, CEO of IBM, Alex Gorski, Johnson & Johnson. I mean, these are mainstream heavyweight CEOs. They just issued a statement on the purpose of a corporation, which really transcends what they'd said in the past. And what they said in the past was that a corporation's primary purpose is to generate profitable returns for their shareholders. Yesterday, Business Roundtable came out and said, while each of our individual companies serves its own corporate purpose, we share a fundamental commitment to all of our stakeholders, not just shareholders, but customers, employees, suppliers, communities, and to contributing to an economy that serves all Americans. So that's what represents mainstream CEO thought today, an indication of how far we've moved over the past 50 years. Socially responsible investing got a major shot in the arm in 2015 when the United Nations adopted a series of sustainable development goals. Go by SDGs. There are a lot of acronyms in this area. For 2030, goals that, in the opinion of the United Nations group that put it together, humanity should aspire to by 2030, like eliminating poverty and hunger, promoting good health and well-being, quality education, gender equality, clean water, clean energy, decent work, reducing inequality. And then they established a series of principles for responsible investing, PRIs, you might have heard of them, which committed any investor that signed on to the PRIs to taking into account whenever they buy a stock or bond, how well the company issuing that stock or bond contributes to the United Nations Sustainable Development Goals. And today, thousands of investment fiduciaries around the world have signed up for that commitment and are members of the United Nations PRI. The whole notion of aligning values with investments it's getting a lot of press right now, and as you'll see, it is one of the most significant trends in the financial services industry, but it's been around for a long time. During the Revolutionary War, pacifists refused to invest in bonds that Congress issued to fund the war. Quakers in the 19th century refused to invest in companies making weapons or exploiting slaves. Eastman Kodak in 1967 was one of the first examples of successful activist investing when shareholders protested the proposed elimination of hundreds of jobs at their headquarters plant. And then, of course, the granddaddy of early socially responsible investment activities was worldwide movement to divest of any stocks and companies doing business with or working with the country of South Africa until South Africa renounced its formal policy of apartheid. Now, the terminology around socially responsible investing creates a lot of confusion. I think it's helpful to use the term socially responsible investing as an umbrella term, and then to think of all the other flavors of socially responsible investing as just that, one or more different versions of efforts to align values with investing activities. Well, we're going to talk about environmental, social, and governance investing a little bit later on, but right on this page, negative screening probably, well, it's not probably, it is the most widely used and probably the longest lived form of socially responsible investing, as the term suggests. It just involves eliminating from your portfolio stocks and bonds issued by companies engaged in activities that run contrary to your values. Now, in the Wall Street Journal within the last couple of months, there was an article on the Norway government pension fund. Now, this is not a small investor. They manage over $1 trillion, and their mandate is the long-term well-being of the people of Norway. And they've concluded that there are activities engaged in by companies around the world that are not consistent with their fiduciary mandate to promote the long-term well-being of the people of Norway. And so they have blacklisted 150 stocks, they're public about it, for reasons including, human rights violations or the fact that these companies make weapons or are involved in the manufacture or distribution of tobacco. Just one example of a major mainstream investor engaged in negative screening. Thematic investing really involves building a portfolio around a cause that you might care deeply about, like clean water, going and finding organizations, corporations engaged primarily in improving the quality of freshwater resources around the world, or climate action, gender equality, animal welfare, ocean health. These are all examples of themes that can be put into practice through investing. Values-based investing is one of the squishiest terms on this list, but I always point to the U.S. Conference of Catholic Bishops, which I think has thought about this topic more carefully and longer than almost anyone I know. They published a set of socially responsible investment guidelines in 2003. I'm just going to quote from it because it articulates, I think, beautifully what they concluded the Catholic Church should be doing when it comes to investing their money. And that is, they said they are called to exercise faithful, competent, and socially responsible stewardship in how we manage our financial resources, which means not just obtaining a reasonable rate of return on our investments, but also exercising ethical and social stewardship in our investment policy based on Catholic moral principles. And then they go on to outline exactly how they think the Catholic Church should do that. Impact investing is a little bit like thematic investing. It's picking something that you feel strongly enough that you want to actually move the needle. Now, I wrote a piece recently on Baird's website called Finance for the Greater Good about legislation that's been introduced in the House of Representatives, the U.S. House of Representatives, that would provide a federal guarantee for bonds issued to fund research, in this case, into cures for blindness. So the legislation is called I-bonds, EYE bonds. And the notion behind it is that there's lots of money for early stage research into medical issues, and there's money once that research can be shown to have commercial applications. But in the middle is something called the Valley of Death, which is where not initial but continuing research and preclinical trials are required to demonstrate commercial viability. And so what Congress is saying is that in these cases, we'll issue bonds we will provide guarantees for bond issues to help fund research into cures for blindness. And people who buy those bonds would be involved in impact investing. That's just one of many examples of impact investing. Now, if you put these different flavors of socially responsible investing onto a continuum, try to organize them in a way that makes sense and is helpful to digest, this is what it might look like. With negative or exclusionary screens on the left-hand side being easier to execute, requiring less money to execute, and generally having lower risk for investors who want to engage in negative screening. And then running all the way up to impact investing or activist investing, which is generally more complicated, requires more money to execute and implement, and generally involves a greater level of risk. And so, this is just one potentially helpful way to organize the different types of socially responsible investing you might be hearing about and reading about. This is socially responsible investing, broadly speaking, the single largest flow of investment dollars in the world is moving into strategies that have one or another types of socially responsible element to them. You can see here on this chart now $12 trillion in assets in the U.S. are in socially responsible strategies, again, of one form or another. And that's a quarter, if you can believe it, a quarter of the assets under management in the United States have some type of SRI flavor to them. Europe has traditionally been ahead of the United States in terms of its rate of adoption of socially responsible investment strategies, but we're catching up. And overall, SRI assets under management grew 34% over the 2-year period shown in this chart. It's so prevalent in Europe now and so mainstream that there's been an interesting 180-degree shift in the regulatory environment there. It used to be that regulators told fiduciaries, investing money for others, that if they considered anything other than financial metrics and making decisions about what investments to make, they would be violating their fiduciary duties to their investor clients. Today, in Europe, as we speak, regulators are telling investors exactly the opposite. They're saying to fiduciaries that if you don't consider non-financial metrics of the type we'll get into in a minute, then you are failing to execute your fiduciary responsibilities to your investors. So we've come full circle as far as what is and is not expected from fiduciaries. Here you can see how assets split out across the different strategies that we've talked about. Negative screening having been around the longest and the most straightforward to execute, has the bulk of the assets. ESG integration is next, and then you drop down to the bottom of the chart. You can see more complicated strategies like impact investing are still in an early stage and still nascent. Now, ESG investing. This is probably the most common and fastest growing area of socially responsible investing today. And ESG just stands for environmental, social, and governance. And I think this chart is busy, but I think it helps demonstrates one of the way in which finance can be a force for good. And this is how. So around the world, institutional investors are making decisions about what companies they are going to invest in, and they're ranking those companies. They've always ranked them based on financial metrics, like revenue growth, profit margin, leverage ratios, hundreds of different financial metrics. But today, before making their investment decisions, they are also involved in analysis around how does a company stack up with respect to its environmental footprint? How is it affecting the climate? Is it depleting the resources we need for life on Earth? Is it polluting, deforesting in any way, contributing to climate change? And then they're ranking those companies based on their score, environmental score. So that's E. Then they're clicking over to how do companies treat their employees? How do they treat the communities in which they're operating? And providing a score on that dimension too, S for social. And the same for governance. What protections are they putting into place for shareholders? What are they doing to ensure they don't engage in unethical, either political lobbying or bribery and corruption? Is their tax strategy inside the lines of what's not just legal but moral? And then giving companies a score on that dimension. So when they sit down and decide whether to put their money in company A or company B, if the choice is between two companies that have exactly the same growth rate or financial profile in the same industry, increasingly individual investors are making the decision to invest in companies with higher scores that rank higher along E, S, and G dimensions. Why? Because the hypothesis has been that really is, those metrics are really a proxy for the quality of management and the quality of a company. And they also give some line of sight into what kind of reputational risk the company will run going forward. What kind of legal liability will they have? What will be their ability to attract and retain the best employees, particularly millennials, who are increasingly interested in working for companies that have a strong E, S, and G profile. So this is almost now an element of even traditional financial analysis, is to look at E, S, and G scores. The problem is that so far there hasn't been any standardization of these metrics. So, everybody, how do you know a quality environmental footprint? Well, you'll know it when you see it. It varies from investment advisor to investment advisor, how they look at these types of metrics. Although, in 2011, a group called the Sustainability Accounting Standards Board was formed to try to put some rigor in standardization across these kinds of metrics. On the other hand, we now have enough data to know, and I would reference, for example, a study recently by McKinsey of 600 companies, 2001 to 2015, and they determined that businesses that rank high on ESG scales generally have higher revenue growth, higher profit growth, and higher total shareholder return. And on the flip side, companies that rank poorly are laggards in financial metrics as well. So that's what ESG investing is all about. I'm pleased to be able to turn the presentation now over to my colleague, Katie Schoen, who Loretta introduced earlier, and she's going to talk about, if you're interested in socially responsible investing, how do you go about implementing it? Katie?
Thanks, John. I'm excited to be here today. And over the past decade or so, I've had the privilege to work in Baird's Private Wealth Management Research Department, where I have consulted on thousands of individual clients and stock client portfolios, including stocks, ETFs, individual bonds as well. And one of the things that I have found when we're having the discussions with financial advisors and their clients is most of the time the investment objective is not just I want to beat a certain index. There's other things around it, other investment metrics and priorities that clients have. And we want to, with this slide, make sure that while income could be important, a lot of times we have clients who have a focus in their investment portfolios in the geographic area that they live in. Additionally, to certain industries that they either really like or that they want to avoid. And we take these metrics and these preferences into account when we're putting together portfolios. SRI, ESG, those values-based investing that you have can be taken into account with that as well. And it's something that we're looking at. So this is just as we're looking at SRI, a bunch of different options as what some people are wanting to exclude when they're looking at their portfolios. Sometimes I like to take a step back, though, and think about things. While I may, it might be very important for me to save the polar bears and not use plastic straws and use environmentally preferenced or renewable resources, well, maybe that can all be lumped under the environmental side of ESG instead of trying to manually go through an investment portfolio and look for individual companies that use plastic straws. So thinking about it more broadly as we're looking at very specific issues that may be important to you can be easier from an implementation standpoint. When we're looking at implementing SRI at Baird, as we've talked about kind of looking at those ESG themes and trying to get more standardization on them, what we've been able to do, and this is just as we've seen that proliferation of ESG assets coming in, is we now have the ability to put together an asset allocation that can potentially match your financial plan using ESG-focused products. We want to make sure that they're the environmental, socially responsible, environmental, social, and governance metrics that they're able to use. So thinking about eliminating certain things broadly like tobacco, firearms, alcohol, having low carbon exposure. And that we've now are launching with a $5,000 minimum so that they can be accessible for clients. Additionally, we know that that's not all-encompassing. There may be certain situations that you're looking at. So the research has also put together different idea screens, whether it really be ESG or a low fossil fuels ETF, being able to put together some investment options that you and your financial advisor, if they're important to you, can discuss and see if it could make sense from an implementation standpoint. Focusing on that, some of the questions that John and I get asked is, how do you do it in practice? How can we make our portfolios match our values? And this is just a few examples that clients have been successful with, but this is really where it's important to have that financial advisor and that conversation with you to be able to tailor the implementation to both your goals as well as being able to have your financial plan. So as we think about just some ways that people have done it in the past, you can add or replace a manager of a fund with an ESG-focused investment vehicle. Well, this can be a great way to do it, making sure that those exposures match what you're looking for your financial plan, as well as being aware of tax implications can be where a financial advisor comes into importance. Additionally, if you look at that chart on the right, what it shows is that if you replaced an iShares MSCI All-Country World Index ETF, basically that's all the stocks out there with the same index fund, but this one has a low carbon tilt towards it, so it replaces or it removes most of the largest carbon producers in an all-world index, that it has a significant reduction in the carbon footprint. That is just a way and a potential as the industry evolves, is that we're seeing more solutions like that to be able to eliminate certain things that could be important to you as you're looking at your values or what do you want to be exposed to. Additionally, we can swap an investment which is less aligned with your goals to one that has a better fit. So thinking about, okay, replacing a tobacco stock with that of an organic foods company. There, again, looking at your portfolio, understanding the investment merits of what you're holding, and then talking to your financial advisor about a solution there, maybe, and as John will talk about in a few minutes, being able to donate that appreciated stock instead of selling it and taking the gains. Those are things where it's really important to have that conversation with. And then again, they're replacing the index fund with one that excludes activities that you don't support. And then invest in new funds to start building up a position in a diversified ESG solution. That's one where when we're thinking about the ESG aligned elements portfolios outside of Baird, how can we get a complete asset allocation so you're not missing something and being able to achieve your financial goals while also still thinking about aligning your investments with the values that may be important to you. And this is, as John talked about, the P word, right? The relative performance. The what do I have to give up if I'm looking to align my investments with my goals? And in the past, the thought was that, you could do this, but you might have to give up some things from a return standpoint. That was the general thought process within the industry. There was some skepticism around this. Now you can see we have the data for some of these indexes that are used, and as you look over time from 1991, this is a KLD 400 social U.S. index versus an S&P 500, that over time it tended to outperform at points. They can underperform. Anytime as an analyst, what we tend to look at, anytime you're exposed differently than the market, you're going to have relative bets that can cause outperformance or underperformance. But as John talked about the characteristics of ESG in that very busy slide, a lot of things make sense from a business perspective. Being able to invest in companies that treat their employees better, or not invest in those companies that treat their employees poorly, could have longer term upside from an investment metric, right? Less turnover, less cost. You can see, and we're starting to, as an industry, see more of these ESG criteria, as John had mentioned, really being thought of as part of a business and where the business risk is, and then the potential for upside for either investing in those that have the best practices, or maybe you just remove those losers, the ones that have the worst and are most exposed. So with that, I want to turn it back over to John to talk about values-based wealth management, because it is more than just the investment process.
Thank you, Katie. And I'm actually going to go back to the slide that you just talked to and say, to reiterate a point you made, and that is that around performance, the argument for why you would give up performance if you were investing in a socially responsible way, the hypothesis behind that was that any time you narrow the opportunity set that you have as an investor, you are going to potentially reduce your ability to invest in the best companies. So it was narrower opportunity set, lower returns. What we're finding is that there's a dynamic, which Katie spoke to, on the other side, which simply put is, if you are able to select a reasonably broad and diversified set of corporations that have demonstrated they have the ability to behave responsibly, then it's not hard to imagine that those corporations would perform better over time because they're not going to get in trouble. They're not going to get sued as much. They're going to be able to attract better employees. And they're not going to have the kind of headline risk that knocks stocks down the way we see from time to time in the marketplace. So what we've been talking about to this point is investment solutions. And we've been talking about how you can approach socially responsible investing in several different ways, either dipping your toe in the SRI waters with a portion of your portfolio, using active or passive investors, active managers or index funds, using screens. And we've been talking about the fact that if you do this properly with the help of a financial advisor, you can do it in many cases without giving up much, if any, investment return. Now, at Baird, we think that investing, so asset allocation, portfolio construction, manager selection, security selection, all the things we've been talking about so far today, we think investing is only one element, albeit an extremely important element of having an integrated approach to wealth management. And we believe that having an integrated approach to wealth management is what helps you maximize your chances of achieving your life goals. Just as it's possible to align your values with your investment activities, it's also possible to align your values across the broad range of wealth management activities so that you can have the biggest possible impact on things that matter most to you. If there's one takeaway from this slide, I would say it's having a plan. It all starts with having a plan. Thinking through carefully, not just what your goals and objectives are, but what your values are. And not just your personal values, but your shared values as couples, your shared values as a family. If I've seen a downside to socially responsible investing, it shows up when investors don't think carefully enough up front about exactly what they're trying to accomplish through one or more types of socially responsible investing. So it starts with a plan, but it extends to charitable giving, to how you spend your time, as well as your investment strategy. These are all parts of wealth management, and they're all ways in which you can put your values to work. So I want to wrap up the presentation part of this morning's call by thanking you all for being on it. The fact that you're interested in learning more about socially responsible investing shows you're optimists at heart. The fact that you're exploring how to put your values to work shows you have hope, hope that together we can, in fact, leave a better world to our children and grandchildren, and optimism and hope are things we simply can't have enough of today. So Loretta, over to you for any questions, or Katie, that we might have gotten from participants on today's call.
Yes, thanks, John. I have one question, or a few questions that have come in, but one that I wanted to focus on right now is that the Business Roundtables announcement was that the topic of this morning's popular podcast, The Daily. They gave historical context of changing trends in the short-term profit versus broader criteria of success. But their conclusion was that at this point it's just signatures on paper, and it's yet to be seen whether this will whether a change in behavior will follow. What do you think about that? Do you think it'll result in any tangible things happening?
I think the Business Roundtable's announcement yesterday, and thank you, Katie, for that question, reflects a change that's already happened or is well on the way to happening in corporate culture. In other words, Milton Friedman came out 50 years ago and made the declaration, much understood, and I'm going to mischaracterize it here, but basically he was interpreted as saying the only objective managers of corporations have is to maximize profit for their shareholders. That's it. Anything else takes their eye off the ball. And for 10 years that I've been talking about this subject, and that I was a CEO myself, I didn't know any CEO of a major corporation that felt that way. CEOs in the 21st century have believed that they have a responsibility to all their constituents. That's certainly the way Baird feels. And all their constituents include not just shareholders, they are constituents, but employees, suppliers, and customers, clients, as well as the communities in which employees, clients, customers, and shareholders live. So that broad-based notion of fiduciary responsibility is one that's been around now for many years. It is different from what was in place, in the post-war years, where it very much was a profit orientation. But that's all changed right now. So I think the Business Roundtable validates what's already been out there. I would also say this, and this might be a little bit controversial, but when we look at where constructive change is coming from, it's not coming from the public sector. In the 20th century, the public sector led most of the values-based policy changes and actual changes in our society. Public sector this century has been locked in dysfunction. It's not a political statement, it's just a fact. And so what you're seeing increasingly is corporations stepping into the breach and taking the lead on issues like environmental sustainability, on diversity and inclusion in the workforce. And why? Because they're getting millions of signals every day from their clients those are things their clients and customers care about, and their clients or customers are telling them that they are going to do business with firms that reflect their values. So you better demonstrate that you have the kind of behaviors that line up with stakeholder values, or you're going to be in trouble if you're running a major corporation.
Thanks, John, for that insight. I tend to completely agree. Within the Baird recommended portfolio, we're doing active management, and those companies where they're on the headlines of the Wall Street Journal, not necessarily for their earnings results, but for poor internal controls, or how they treat clients. You don't want to own those names, right? You don't want your investments having that negative press. And I think we're also seeing some investors now putting higher values on those companies with those strong ESG or strong business morals, so to speak, and giving a discounted valuation to those that tend to be on the headlines for the wrong reasons. I got another question here, and I can take this one. The question was, how often will ESG reviews be done for companies? And most of the time, with a lot of the reviews that we're seeing, or the products that we're seeing, so to speak, if it's an index space, they tend to use filings. What does a company file? How have they disclosed their different ESG characteristics? If you're doing more of an active manager, they can tend to be more dynamic with when they're doing reviews and update on a regular basis. But for most of the indices that we've seen, they are using when the company files their 10Ks or Qs, they pull the data from that. So I have a question for you, John, as we've been looking through, or you've been following this space, and I know you're incredibly passionate about it. Where do you see it going? If we are on this call for 5 years from now, what do you get excited about? Where do you think that there's going to be continued opportunity?
Well, I think what we've seen in Europe and globally is that it's the largest and most sophisticated investors in the world, institutions of various kinds, who have taken the lead in socially responsible investing over the last decade or so. And what I think we're going to see is continued growth in this area. In other words, more dollars will continue to flow into strategies that have one or another type of SRI flavor to them, but that we'll see socially responsible investing increasingly moving down to individual investors, the tools that are available to individual investors, the platforms that firms like Baird offer to individual investor clients are dramatically better and easier to use today, and bring more of these strategies within reach of individual investors. So I think growth will continue. Individual investors will become greater and greater participants in this field. And I think this is all positive because I think the end result is that companies will be rewarded, management teams will be rewarded for behaving responsibly in a way more impactfully than they have in the past.
John,
Thank you.
One question from my end. So in addition to their financial advisors, and perhaps Katie, you'd like to weigh in on this as well, if someone wants to do a little bit more research, learn a little bit more, where should the average investor go to find that information?
Katie, why don't you take that?
Yeah, I'm happy to. So some of the MSCI that does many of these indices that we talk about, they have a great resource and tools within their website to be able to see where criteria are, how they screen in different ways. There's also, we're starting to see a few, as John's talked about, innovation and what makes sense. There's a few other different resources that are available. Baird doesn't have necessarily contracts or partnerships with any of them, but that are publicly available that can be great resources. I like Just Capital, JUST Capital. They do a ranking, and they publicize their rankings on what they believe are just companies, and anyone can go in and they can see them, and you can read the rationale around them. MSCI is great as well. Baird does have a very informative white paper that we have available. We also have additional resources on many of the funds that we've talked about, from what are they, both passive in an ETF form or active management. So I would encourage you to have those conversations with your financial advisor as well. And I would also kind of caution, as a lot of times we hear things within different funds that have different exposures or what is going on with a certain company. So I think that also making sure that you're getting good information instead of what someone's opinion is on a blog is also very important in this space, because they can have financial repercussions for you and your financial plan.
Well, thank you very much, John and Katie. I appreciate your insights today, and we really appreciated your thoughts in this very interesting area. For those of you on the line, you'll be seeing a survey up on the screen in just a moment. Please take a moment to complete this so that we can continue to improve these calls and make them relevant to you and topics that you want to learn about. And our next Baird Wealth Strategies call will be on September 18th. The topic will be leveraging Baird technology, making your finances simple and easy. So thank you again to John and Katie for your comments today, and thanks to all of you for dialing in.
Thank you again for joining us today. This concludes today's web conference. You may now disconnect. Have a great day.